BEE schemes. Old Mutual just announced their BEE, their new BEE scheme. And a lot of people are asking me, am I buying it? Why am I not buying it? Etc. etc. This is a personal decision. If you want to buy into this, it is a great tool for getting into the market, for being locked in. There are lock-in periods. I know they currently, Old Mutual announced a 5-year lock-in period. After the 5-year lock-in period, I think you can sell, to other previously disadvantaged people, so people who qualify. But just be careful of the lock-in periods. This is not how every single scheme works. The steps are not identical. I'm telling you what steps needs to be taken for a BEE scheme to come into existence, and how it looks and what you need to be aware of. So the first thing is the company must buy the shares. The BEE scheme company must buy the scheme shares. So they're either going to buy it on the open market, or they are going to create new shares. When a company creates new shares, remember, a company's share price is literally the value of the company divided by the amount of shares. If you increase the number below the line, the share price is going to drop. So you can't just create shares out of thin air and think that the share price is not going to drop. So that's the one thing I want you to watch out for. The next thing is they sell you the shares, the retail shareholders or the employees or the community schemes. All of them normally have an employee part, a community part, and a retail part. And that's where we come in, where we can buy it on the JSE. Then there's a part where a lot of people are not aware of, and that is raising the debt. Because if a share price is 10 Rand, like on the open market, Old Mutual costs 10 Rand, they're selling it to you for a 40% discount. Who's going to fund the difference? They need to raise debt. Nobody's just going to donate that money. I'll show you a slide. Then dividends are very important. What are they going to do with the dividends? They're either going to use the dividends to repay the debt, or they are going to use the dividends to pay it out to shareholders, or a combination of both. You need to know how the share scheme works. And the last part is the nicest one, because that is the share price movement. If the value of Old Mutual goes up, your share price goes up. If the value of Old Mutual goes down, unfortunately, your share price goes down. But we are long-term investors, and that's why we don't cry about the lock-in periods. We are here to create long-term wealth. Now, let's look at example number 1. And for people who hate a balance sheet, I'm sorry, you are in Saul's class. You are going to need to understand how a balance sheet works. A balance sheet is always the assets must equal the liabilities plus the equity. The liabilities is the money the banks put in. The equity is the money that the shareholders put in. Okay, so let's say Old Mutual goes out into the open market. I know they are creating new shares, but I'm making an example, okay? So let's say they go out into the open market and they buy 60 million shares at 10 Rand each. That means now they have an asset on their balance sheet of 600 million, but 600 million in cash left the bank. So there's a liability, a bank overdraft or something, okay? This is just an example. Now let's go to the next one. They are now going to sell us these shares, but because we are previously disadvantaged and they want to empower us, they're giving us the shares for 6 Rand a share. Okay, so now we are going to put in 360 million into the company, which means the difference between, it's becoming smaller now, because the shareholders have put in 360 million. Can you see your balance sheet still balances? Because The banks have put in on the net 240 and the shareholders have put in 360, but there's still an asset worth 600. So your balance sheet still balances. But the danger is we owe somebody. The scheme owes somebody 240 million. Now let's go to the next slide. Now they're going to raise the debt because we don't want to owe people. We can't have a bank overdraft, okay? So what do? We raise debt to fund that gap so that instead of having a bank overdraft or owing somebody money, we go and take out a loan and we say, we now have a loan. This loan is not for free, guys. The loan comes with interest and the loan needs to be repaid. Okay. Now, what is the end result of everything I've just shown you? Is you end up with a balance sheet that has an asset called Old Mutual or Vodacom or SAB or MTN that has an asset of 600 million, and you end up with a balance sheet where you owe the bank 240 and you owe the shareholders have put in 360. I always say a balance sheet must balance because if there's 600 million in assets, who paid for those assets? The bank paid for it and the shareholders paid for it. So the balance sheet balances. Now, this is where BEE schemes are different. You got the shares at a discount, but now you need to repay the debt. So you can't expect a full dividend in the first 5 to 10 years of the existence of the scheme. The other thing people are very ignorant about is that this share price can go up or it can go down. So before investing in a BEE scheme and just going in for the discount, what do you think is going to happen to the underlying asset? Because this is not a trading company. This is not a company. The BEE scheme itself has nothing else happening in it. It's not a business that's buying and selling stuff. Old Mutual is the company. This is just an investment in Old Mutual or an investment in MTN. So this company has no other income except for the dividends coming in. So the only thing you own is you own the BEE share, but you need to repay the debt and the shareholders have put in their money. If the share price goes up, it means, let's say the share price goes up and this is now worth 200 million, okay? Then they're going to add 200 million here and they're going to add 200 million on that side, okay? Which means the shareholders' money is worth more. But it can also go the opposite direction. If this goes down to 500, this one is also going to go down by 100 million. So it's understand the rules. My preference, and it's because I've been investing for a long time, is owning the underlying asset myself, okay? I always go and evaluate, is the discount worth it? The other thing people are doing is, because these things are on exchanges, Old Mutual is issuing this thing as 10 Rand a share. As soon as it lists on an exchange and it becomes publicly traded, we have the habit of competing with each other and, you know, chasing share prices up. And then you pay more for something than the net asset value of the company. So if somebody ever says, what is the net asset value of a business? It's the assets minus the liabilities. It's the value that is sitting there for the shareholders. So that's the ins and outs of it. It's really just they buy the assets, they sell it to us, they raise the debt, they get dividends, they service the debt, pay dividends to shareholders. The only way you're going to get rich off this thing is if the underlying asset performs, because there are no other operations inside a BEE scheme.